Morning, everybody. Welcome into our weekly market update. I'm joined by Scott and Ryan to discuss a fascinating week in the market. Investors had to digest an unexpected decline in payrolls, record highs, continued AI-driven momentum, and ongoing geopolitical tensions involving Iran and oil prices. Let's dive right into it. Scott, investors got a surprise this week when payrolls unexpectedly declined by 2,300 jobs. Yet despite weaker employment data, stocks rallied to new all-time highs. What's the market telling us right now?
The market is telling us they don't want higher rates. As I've been talking about on this program and other programs, the big risk out there is stagflation. So the lower employment numbers suggested to the market that perhaps the Fed's not going to have to be as aggressive raising rates, and they may even want to consider cutting rates. And I think that's been a big stimulus for the market here.
Scott, I agree. You go back a couple of years ago, you were saying that, what happens if bombs in Iran go off and all of a sudden oil spikes, like the Fed can't jump the gun and cut too early, right? They should hold, if not raise. Well, I think because, you had a strong economy then, I think you're starting to see signs of economic weakness. That jobs report doesn't tell the whole story, but I think it's a leading indicator showing people are struggling. Now we might need some stimulus. And on the back of that, we've seen a rotation, a bit of a yo-yo back and forth with what's been the leader. Last week you saw strength from NVIDIA, Broadcom. So companies that are showing actual earnings growth and not just an AI story, I think that was a big part of it too. You have falling yields supporting valuations. The market's saying if rates are stable and earnings continue to grow, stocks continue to work higher. So I think you've seen maybe that the Fed's going to potentially cut, if not stay level and not raise, which is a great sign. And investors aren't just buying AI, they're buying earnings growth fueled by AI. So those two things really were the swing from last week.
So it's funny, Ryan. It's funny you say that. Coming into last week, we had seen a big dichotomy between the equally weighted S&P and the market cap weighted. For the first time, and as long as I can remember, the equally weighted was outperforming the market cap weighted, which is very tech heavy, by quite a bit. Last week, the S&P caught up. So it was really interesting. And getting back to really the crux of Jordan's question, what's the market telling us? The market's telling us that the safety trade is in these big tech names in the semis, because as soon as the market's getting worried about the job market, it's rotating there. So intuitively, we know it's not just because it's safe. We know it is a volatile sector. It's because the market is hoping for lower rates, not higher rates.
Yeah, I agree. And while we're talking about semis, Ryan, semiconductor stocks surged more than 7% this past week, and AI-related companies continue to drive market returns. Are we seeing the start of a rotation, or is AI leadership still firmly in place?
I still think that leadership's very much intact, and last week's rally reinforced that. But the Nasdaq outperforming, like you mentioned, semis rebounding sharply, and companies tied to AI infrastructure, which I know Scott and I have talked about ad nauseum the last year or two on various programs, remain the winners. So you got NVIDIA, Broadcom continuing to benefit from this enormous demand in computing power, data centers. But what I'm really watching, though, isn't whether or not that leadership ends or rotates. It's whether it broadens. We mentioned that last week, right? Like, when are other industries going to take part in this rally and not necessarily take the leadership position? We saw the first phase of this cycle was all about building infrastructure, right? Chip makers, cloud providers, the actual stuff in the ground that we need and the energy to provide it. So the next phase, and if you look for a rotation or maybe a joint leadership, if not a rotation out of leadership, is about adaptation and monetization. You're looking at industrial companies investing in automation, financial institutions deploying AI. I mean, we see it in our day-to-day life in what we do for client service and productivity. And then you have healthcare companies using AI for diagnostics, research, and operational efficiencies. So it might not just be that the next wave doesn't include the companies that we have invested in and talked about, but it's other industries as well finally join it.
So guys, if you're a CEO of a company, what's your biggest risk today? Is your risk that you've overspent in AI or that you've underspent? So think about that, right? The leaders of these companies, as much as everyone's talking about the CapEx being so high, it might actually not be enough in some companies. And I think, the CEOs and the finance teams have a serious responsibility to their shareholders and their companies to make sure they are partaking.
Yeah, and I think that's part of the tightrope we're seeing, right? Like every time earnings come out, it just kind of looks at what guidance is. And if the investors get spooked that they're spending too much money, if free cash flows flying out the window and they're sitting here short term asking, well, where's the profitability finally coming from? Scott, you and I have talked about this. I think it's very short sighted. We're very early into this technology revolution, especially on the artificial intelligence front. So looking for short-term profitability when you're worried about your biggest risk might not be spending enough, like you said, and losing out in the long term to other competitors.
Scott, last week you were on the stock exchange floor talking about what the Fed should do. With geopolitical tensions involving Iran continuing to create uncertainty around oil prices, how does the Fed balance slowing job growth against potentially higher energy costs?
Yeah, it's a delicate balance. There's no question about it. And, I think I kind of answered it, and the market has answered it. Market wants lower rates. And I think, the economist is simply going to look at it and say inflation's up, we've got to squeeze inflation. Stagflation is the risk. I know you could be listening to me saying, you've said this over and over, it's time for a new story. It's not. We have to ward off stagflation. Stagnant economy, inflation. Inflation is not a demand issue right now. We don't have excess demand where people are spending through the roof. The consumer needs a stimulus. If the consumer is spending more money at the gas pump, now think about it. When they're spending at the gas pump, the food that they're getting costs more because it has to be shipped here. And the equipment that pulls the food out of the ground, the gas for that is higher. So the consumer needs a stimulus. If they're spending more money on things, how are they going to keep up in a slowing job market? Wage growth hasn't been what we'd all like. The stimulus is cutting rates, so their credit cards, their mortgage payments, their car payments are a little bit lower. That'll keep us out of this 1970 style mess.
As we look at the week ahead, what's one economic report, market indicator, or headline that you'll be watching most closely that you're talking to clients about this week?
So look, I focus more on market indicators than the numbers that come out because whatever the numbers are, the market's going to react to them a certain way. When the Fed held rates steady the other day, they sold off the market. Some would argue they sold it off because the market wanted them to ward off inflation by raising. Some said, well, they want them to be thinking about lowering. So I don't really worry about the data that comes out because it's the market reaction. So market data points. I am looking to see if the traditional S&P 500 now passes the equally weighted this week. That would be a tremendous shift in sentiment of the market, more of a risk on sentiment. I also look at the VIX. We've talked about the VIX, the volatility index. Right now it's, I think, trading around 15. When it gets up to about 30, that's when it's time to buy stocks. A couple weeks ago when the market seemed to be in risk off mode, all of a sudden the VIX crept up to 20, 22. Not quite my buy indicator at 30, but as that goes up, that's when fear starts to come with the market. You don't necessarily want to buy the market when everybody gets complacent. So, there's a couple things in the markets that I'm looking for.
Ryan, what about you?
I agree with Scott. I would argue that any short-term data point without proper context doesn't really tell the full story of what the market's feeling anyway. In the short term, I look at price of oil, any headlines coming out of Iran of a potential deal or not to open up the Strait of Hormuz. Now, again, you've seen over the weekend conflicting conversations between the Iranian government and President Trump, whether or not a deal is being reached, negotiated, and where we may or may not withdraw from Iran. So I think in the short term, you focus on that, what volatility that causes, and potential, leading indicators for the Fed on top of that jobs number last week. But again, looking at it more broadly, we think the buy's on. I think that there's a lot of tailwinds for this market, and if you're an investor, continue to look for opportunities where potential sell-offs may happen and get in.
Great. Thank you guys always for joining us. We'll see you guys next week. For everybody else who tuned in, thank you for watching. You can find us across any of our social channels at ZDTV and ZD Private Wealth.